All right. Good morning, good afternoon. It's 12 o'clock. Thank you all so much for joining us for today's Access to Insight webinar. This is our first webinar in a little while, so it's really fantastic to have so many people joining us today. My name is Ollie Ben. I am Vice President of Philanthropy for the Jewish Community Foundation. And this should be a fascinating session today with some really, really wonderful speakers and a very well-timed session on end of year giving and end of year planning. So before I get going, a few updates. As you know, we integrated recently with the Liechtenstein Foundation's Impact Cube team. That has been an incredibly successful and additive joining of teams together. We will be putting out an entire sort of donor education series. The details of that are going to be announced in the next few weeks. And so really one of the benefits of this combination is the addition of these wonderful people who are going to be really like adding to the amount of material and the richness of the philanthropic contributions that we can all make together. So stand by for that update, which will be coming out shortly. Additionally, as a supplement to today's session, you might be interested. I'm going to put a link in the chat, but we've put a really nice end of year web page together. I'm actually going to show that to you really quickly now. Let me just put this in the chat, the link. You can look at this after the session. Um, but we've put together a page that has all kinds of information, including obviously deadlines and things like that. But it also includes, I'm just waiting for it to pull up on my screen, my apologies. Um, Here we go. Um, but in addition to all of our deadlines and who to talk to, it also has a really nice end of year charitable planning guide with some specific information, some giving opportunities if you're looking for specific ideas of where to give. That is something that is also available to you. And then a really lovely session or section that Sharon Goodson, our Senior VP of Philanthropy, put together about raising generous children, how to get your family involved in philanthropy, and additionally, some end of year volunteering opportunities. So I put the link in the chat. I'll post that again afterwards or at the end, but I just wanted to let you know that that's a great additional resource that is available. Our session today, we're going to be talking at three levels of abstraction. First of all, we're going to zoom way out to talk about where the markets are today, what's been happening in the markets, and what the outlook is for the coming months and year, which will be led by Nick Picaretta from Mercer. Then we're going to zoom in to talk about whether we call it the One Big Beautiful Bill, OBB3, OBBA. It has lots of different names, but what the omnibus bill, the changes mean for your own planning and for your own philanthropic planning, especially. And then we're going to zoom right in and get super tactical about the changes that you can consider making at this end of the year, which will be led by our very own Charlene Wallach, our Chief Impact Officer. So the first speaker is Nick Picaretta from Mercer. And I just want to introduce Nick by saying that we at the Jewish Community Foundation, we're closing in on $1 billion of assets under management. That is a huge responsibility that we take very seriously because this is obviously not our money, this is community assets, and we have to be very careful in the way we steward that. And we take that as a very serious responsibility. So we really have three levels of stewardship of those assets. Obviously, our own financial staff, our finance team, starting with our CEO, Jeremy Pearl, formerly of KPMG, our CFO, Eli Landau, formerly of Deloitte, and the whole team, the whole finance team that rigorously manages your money on a day-to-day basis. We then have an investment committee, which is made up of lay leaders who work professionally as wealth managers, financial advisors, CPAs, CFAs, et cetera, who are responsible for sort of identifying and directing where those investment pool monies should be allocated. But then we also have an outside chief investment firm, Mercer, which is where Nick works, And they oversee on a day-to-day basis those investment pools. They work closely with our investment committee to help us to enable us really to move more quickly in all sorts of capital markets to maximize returns. So that's where Nick works, and he's going to provide an overview of where markets currently stand and where they might be going. Um, We'll be happy to take questions as the session progresses. As a reminder, any questions that you ask, we will not be able to provide personal financial advice. Always consult your own professional advisor. But we will provide as specific information as we possibly can. But obviously, it's all advice is sort of generalized, and please consult your own personal financial advisor. So with that, first of all, I'm going to turn it over to Nick, and then we're going to turn it over to Lorenzo Sanchez from Pathview. Pathview is also a wonderful partner of ours. They are a local wealth management and advisory firm, and we've worked with them successfully for many years, and then over to Charlene after that. But first of all, Nick, take it away. And you are on mute, Nick.
Amateur mistake.
There we go.
Thank you. Thank you, Holly. Appreciate the time here today. You did a beautiful job of setting it up. My goal here today is to start with that high level economic overview, discuss our thoughts on where the economy stands today, where we think it's going forward, and work from there. Shed some light on the tariffs, our thoughts on the one big beautiful bill, and then move into what we think about some hot topics in the markets right now, such as the Mag 7 and how it impacts how we're approaching portfolio management for the community. So feel free to interject with questions. I'm a consultant. I have no problem hearing my own voice and get on a roll here. So feel free to interject at any time, as I'm happy to address questions as they come up. But starting off, just to give you a good sense of economics, starting at the very top, I always say the important thing, you always want to decouple the economy from company profitability from market valuations. Those are different things. There's different things that impact them. But that said, it is a foundation of the environment we're in is based on economic outlooks. And the real theme right now is things right now are the economy is still okay, but it is weakening. And there are a few things that we really need to take into consideration. So just looking at GDP on the left, you can see the trend there from 24 to 25. US is in the blue, scaled to the left part of that graph, 2 3/4 last year. This year, probably going to be more in 1 3/4. We are seeing slower growth, and we're starting to see some of that weakening in the economy. So we're starting to see unemployment start to tick up. We're starting to see lower jobs numbers, although today was a little bit better, still not great. And so we are seeing some weakening in the economy. At the same time, and largely due to a lot of policy that's going on, such as from the tariffs and things of that nature, we're seeing inflation tick up. Those are not things we want to see working in opposite directions. And so that creates a very challenging environment. For a challenging environment for the Fed, a challenging investment environment. And this is, you'll get into the investment thesis at the end. But our objective overall is to build all weather portfolios that regardless of the environment we are in, we're going to do okay. And we're going to do good. But we are starting to see some cracks. And that's where you will see in the middle there. I always love the recession probabilities because they're almost always wrong. They always talk about, you get economists, they're wrong over 50% of the time. I was going into 2023, like we have a very high likelihood of recession. It never happened. And eventually it'll happen when the probability is a little bit lower. It's a binary outcome. But we do see that are seeing a little bit of a tick up in inflation from last year. It has gone down as the year's gone on, as fears have eased on the impact of tariffs, mainly because a lot of them have been rolled back. With that, so has the probability of recession. But nonetheless, we are seeing slower growth, and with slower growth becomes more of a likelihood of an inflation or of a recession. And then when you look at the top right, I think really shows you the conundrum that the Fed is in. The Fed has two mandates. They want to keep unemployment at a low rate, and they want to minimize inflation. They usually keep it at about a 2% range. Well, neither of those things are happening right now. Inflation's is painfully sticky around 3%. At the same time, unemployment is rising. And so with that, they basically have a choice. You can't do both at the same time. You have to pick one and live with some outcomes. And they're picking right now, the Fed has indicated they're going to focus on economic growth. They're going to focus on the job market. So even if inflation's high, we still do expect a likelihood interest rates will come down. And that impacts borrowing rates, but also impacts what the kind of returns that you see on cash are going down. The 4 to 4.25% money markets that you get in a lot of with a lot of asset managers out there, 3% plus from banks. That stuff's usually just going to start to tick down a little bit because as they continue to fight rising unemployment, that is it is likely that you will continue to see interest rates go down. So overall, as I say, we're in a stable mode right now, but things are weakening. And right now, the momentum is towards continuing weakening. So that's from an economic standpoint. I'll get into markets, our outlook on markets, because that's not necessarily the same thing in a few minutes, but that hopefully paints a picture of the environment we're in, where we think it's going in 2026. But deconstructing this a little bit to go a level lower, why are things weakening? And one of the things that we see is a lot of it's tariffs. Now, I like this chart a lot because it really puts into perspective where we are compared to history. So tariffs are something that have really been reduced and used very strategically in certain markets, really since World War II. We're in a globalized economy. There are certain areas where tariffs have been very useful, such as in the EV car market. If China was able just to come into America, they can do it for a fraction of our costs. It would kill any type of EV market in production in the States. So there's tariffs on that, or even restrictions on China selling their EVs out. It's very strategic. That's how it's been used. You can see the rates going back at the turn of the last century. Tariff rates were high. They came down, and they've been pretty steadily, in the single digits, low single digits since World War II. New administration comes in, tariff everything. And that's where we saw that you see that peak of 30% tariff rates on average across the economy. For then that peaked on April 8th, that first week of April, the tariff tantrum, where we saw markets pull back 10% in a week. We started seeing long-term bond yields start to spike. The 30-year went above 5%. Well, the administration said, well, we really need to pull back. That's not what we want to have happen. And they've gradually peeled back. And as of September 31st, the projected tariff rate was 19%, but the effective tariff rate, because of all the exceptions everywhere, is actually closer to probably 10%. So we're gradually seeing this come back. You've seen a lot pull back on food, coffee, bananas, things that there were tariffs on that could not be produced in America. That are raising grocery prices. Those things have all started to be pared back. But what we've seen overall is about 0.5% of GDP has been dragged down because of the tariffs so far in 2025. So this is something that we're keeping an eye on. It's going in the down direction. But this is something that has been a certain headwind for the economy. And a lot of, when we think about the impact on markets, a lot of the individual companies, the unpredictability, tough to build a multi-billion-dollar plant that takes 5 years when the rules of the game are changing every week. So that's the stuff that brings uncertainty and reduces economic investment. But that said, a lot of this stuff still has not been fully felt by the economy yet. And so we think about, a lot of when you're talking about inventories, if you're, furniture, if you're selling furniture or things like that, they built up a lot of inventory before the tariffs went into effect. So they locked in their costs, they built up their inventory. That's why we saw strong GDP growth in Q1, because they were just loading up on inventory. So lots of purchasing, and that stuff becomes a drag in later quarters. But that inventory buildup means that they're able to sell those goods at regular prices without those tariffs being passed on. As that inventory goes away, then those costs are more likely to be passed on to consumers. Call me a skeptic, but corporate America usually likes to make money, and corporations aren't going to eat those profit margins forever. At some point, those costs are going to be passed along to us. And we've seen that in more markets like food, where they are consumable. And then that has an immediate impact on our grocery prices. So when you see that inventory build up and it starts to go through, compression, margins get compressed for corporations. They're going to start to raise prices. That's going to weaken demand. There's going to be more uncertainty. These are the things where those tariffs are gradually are being felt through the economy, and that's going to probably be magnified here. We're kind of in it right now, but I think you'll still start to see this more over the next few months. Couple more here, but one of the other things I like to touch on, what's the impact of the one big beautiful bill? And Lorenzo's going to do a more bigger dive on this, but economically, I just think it is good to set expectations. I talked about tariffs being a drag on GDP, but we're still seeing good GDP numbers. Markets are still flying high. They've doubled in 3 years, and they're up, 20% this year. Whoa, what's a catalyst for that? Well, when you look at the impact of the one big beautiful bill, you can see all the individual components, but follow that pink line. When that pink line is going up, it's stimulative to the economy. And again, being a skeptic about politicians, what do you see? All those benefits are felt before the midterms in 2026, and then they're still stimulative for 27, 28, and then right when the next presidential election, it becomes a net detractor. But in the short term, it's very stimulative of the economy. So you talk about tax cuts, you talk about spending increases in certain areas, and you talk about a lot of the spending cuts being very focused in healthcare in 2026, but otherwise, a lot of those don't get felt until later years. Those are things that are stimulative in the near term and help support GDP growth, even while the future is going to look is going to have there's going to be a lot more impacts in the future. So that hopefully sets the stage on some of this economic impact. Just looking now really at the hot topic in the markets. So when we think about some of the things that we're hearing a lot about in the economy right now. This is these next two charts are some of my favorites. And I had to dig the next one out from about 6 years ago, but it's very applicable, I think, to this group. But when we think about, you hear a lot in the market right now about, are we in a bubble? Is this like the 2000 tech bubble? We see all of the rapid valuation increases in these tech companies. Does that create that bubble that's akin to 2000? And what I would say empirically is no, this is very different than 2000. Those companies in 2000s had high prices and low to negative earnings. Today, these companies are doing extremely well. We saw that with NVIDIA beating their goals again yesterday, their revenue targets. These companies are making money. So even though their valuations are a little bit higher than the historical averages, their earnings are far surpassing the other companies, the S&P 500. So you talk about the S&P 7 and the S&P 493. These Mag 7s are doing extremely well. But one of the outcomes of this is now we see the S&P 500 is highly concentrated. You'll notice those 7 names at the top through Tesla make up about 35% of the S&P 500. You see back to historical norms, it's usually, the top 10 companies make up close to 20%. Now it's close to 40. There is a lot of concentration there. But that on its face does not mean that that is a problem or that we're in a bubble. These companies are doing very well. They have high earnings. They have a competitive advantage and first mover advantages into the AI in the future. And the value is increasing. But the thing I always tell groups is, this is the great thing. This is what we bring to our portfolio management. We're going to invest in everybody. History is written by the winners, and the market is no different. And I'll show you in a second, but 95% of returns come from 4% of the companies. So, and I love this chart because this is when it only looks at 1987 to 2017, but it goes back to the Great Depression. Since the Great Depression, 95% of markets returns come from 4% of the companies. I can tell you right now, half of this portfolio that we're managing is going to lose money. I can tell you about 85% of it is actually going to do worse than a T-bill. But those over 1,000% winners, those are the ones that are going to really drive the market performance in the long run. So when we build portfolios, we're building portfolios that have a lot of diversification in them, not just with equities and fixed income, but also alternatives. That's something that we're using investments that act a little bit to help diversify and act differently than bonds and act differently than equities. So regardless of the market outcome, we're going to hopefully take advantage of different areas, and we'll make some tilts here and there in order to take advantage of it. But at the end of the day, what is our objective? Our objective is to have a material allocation to all these winners, because that is how we add long-term returns to a portfolio. And that's how we avoid having situations where the market's up 10%, but you're down 3%. Those type of situations aren't going to happen with a portfolio like we're managing, because we are going to be heavily invested in a lot of these winners. And how do we do that? We're invested heavily in the S&P 500 in a market cap weighted way. We'll have some tilts in areas of the market, but we're going to capture the returns that these winners provide us. So at the end of the day, that you're going to be there's going to be a healthy allocation here. There is potential for pullback, especially in the AI space. There's gonna be a period where this portfolio is down 10 or 20%. Those times are gonna happen, but long term, you're in a good spot. And the last thing that I'll say is the investment committee that we work with. They're very active in their oversight of us. It's not just we come there and say, "Yep, markets are up, we're doing good," and we move on. They ask a lot of very tough questions and keep us on our toes. They are not easy meetings. And so it does there is a high level of fiduciary oversight provided by the committee and challenging of our methodology and our construction process to make sure that we are generating good outcomes. So just rest assured that the foundation is in good hands there.
Oh,
Happy to address any questions now or throughout at the end, but hopefully that just gives you a sense of where we think markets are going and where the economy stands as well.
fantastic. That was incredibly, you covered a lot of material in a very short period of time. Thank you very much, Nick. Now over to Lorenzo Sanchez from Pathview here in San Diego, who I'm excited to show. He will be talking about the impact of the One Big Beautiful Bill a bit more. Don't forget to, yep, there you go. Great.
All right. Thanks, Nick. That was great. Um, Hey everyone, my name is Lorenzo. I'm one of three partners at a fee-only fiduciary wealth management firm here in Mission Valley called Pathview. Our firm specializes in tax-efficient financial planning and wealth management. We do have CPAs on our team, but full disclosure, I will say that I am not one of those CPAs. I am on the financial planning and investment side. That said, I'm going to try and help you navigate how the One Big Beautiful Bill Act, OBBA or OBB3, affected charitable giving from a tax point of view. To make things easier going forward, I'm going to call this new bill the new tax bill or the tax bill. It'll just save us a couple of seconds overall through these slides. All right, let's get started. Okay. So for today's presentation, we split up the new tax bill's effects into how they impact non-itemizers and then those who do itemize. So we're going to start with people who take the standard deduction or non-itemizers. A lot of what the new tax bill did was make the Tax Cuts and Jobs Act provisions permanent. One of those being the higher standard deductions that were introduced in 2016. As you can see on this slide, the standard deduction amount impacts a lot of Americans. Over 85% of taxpayers are projected to take the standard deduction in 2026. Much more relevant to today's conversation is the tax bill's permanent above the line charitable deduction. So starting in 2026, $1,000 can be deducted above the line for taxpayers who claim the standard deduction. There was a similar and temporary provision introduced during the COVID pandemic. At that time, over 90 million taxpayers claimed it between 2020 and 2021. So we believe that this provision will be popular amongst American taxpayers. That was nice and short. Now let's look at how the new tax bill affects non-itemizers. Sorry, people who do itemize. Starting in 2026, taxpayers who do itemize will lose a portion of the tax benefit they receive for charitable contributions. Specifically, there is now an AGI-based floor to charitable contributions. Those who itemize and make charitable donations will only begin receiving a tax benefit after their contributions surpass 0.5% of their AGI or adjusted gross income. So real quick example, taxpayer with an AGI of 200,000 can only deduct contributions in excess of 1,000, which is 0.5% of 200,000. The new tax bill also permanently extends the higher deduction limit for cash contributions at 60% of gross income. Furthermore, non-cash contributions remain capped at 50% of AGI max. It's important to note the ordering rules. So cash gifts are deducted first, which means that if you make both cash and non-cash donations, the higher limit for cash may not fully apply to those. The new tax bill also limits the benefit of itemized deductions for top bracket taxpayers. Starting in 2026, those in the highest tax bracket will see the value of their itemized deductions drop from 37 cents to 35 cents on the dollar. The math here is a bit tricky, but I'm going to try and simplify it for you. So to figure out your reduced deduction, you would take your AGI and add your itemized deductions to it. You would then multiply the lesser of your itemized deductions or the income that exceeds the 37% tax bracket by 2/37, just a fraction, 2/37, or about 5.4%. So for example, a household with an AGI of 800,000 and 100,000 of deductions would have an income base of 900,000 for the purpose of this calculation. Let's say that about 280,000 of that income falls in the 37% tax bracket. Since 100,000, which are their deductions, is smaller than 280,000, we apply the 5.4% to the 100,000, which equals about 5,400. So instead of deducting 100,000, they're only able to deduct 94,600. Last but not least, the new tax bill increased the state and local tax deduction, or SALT for short, temporarily to 40,000, with a phase out that begins of 500,000 of income. This part of the bill has been thoroughly discussed, so I won't spend too much time here. I'll just mention that it is set to revert back to 10,000 after 2029. So given all that information, what's one thing related to charitable giving that we are looking into for all of our clients who itemize and make donations? Well, we know that in 2026, these clients will lose some of the benefits given the new 0.5% floor on deductions. And we also know that those in the highest tax bracket will also be negatively affected by this new tax bill. So we're advising that clients look into front-loading their charitable contributions to the 2025 calendar year to get the maximum benefit before the new rules kick in. So here's what we mean. Say a household is giving $1,000 a year to their favorite charity. Our suggestion would be to bunch up or front-load as many years' worth of contributions into the 2025 tax year. Doing so would give them the biggest bang for their buck from a tax perspective. About 90 seconds or 2 slides, I'm going to pass over the mic to Charlene, who's going to talk to you about a popular vehicle the foundation has that can facilitate the strategy. All right, almost done. Let's look just quickly at a couple of other changes in the new tax bill brought, and then we'll just do a short, long view of the bill's impact. The new bill introduced a new tax credit related to charitable giving. I find this one very interesting. So beginning in 2027, taxpayers may receive a non-refundable credit of up to $1,700 for contributions made to SGOs or scholarship granting organizations. I think more research and information on this credit will surface as we get closer to 2027, but this will be something that we'll want to keep in our radars. Last but not least, one more change. There was also a floor on charitable contribution deductions of 1% of taxable income that will be introduced for corporations starting in 2026. So let's just quickly wrap up with a long-term view of the bill's effects. The new tax bill brings major changes to charitable giving. For higher income taxpayers, itemized deductions are now more limited, reducing the tax benefits of charitable donations. On the other hand, non-itemizers get a boost with the new above-the-line deduction, encouraging more people to give. This new deduction is expected to reduce government revenue by about $74 billion over the next decade, but the new floor on charitable deductions will offset much of that. In the near term, this bunching, this front-loading strategy, many donors may want to front-load their contributions before the new limitations take effect into 2026. And with that, I'm going to turn this over to Charlene. We'll wrap it up.
Thanks, Lorenzo. Hi, everybody. I will just get my slides going and then we'll be all set. Okay, so you might wonder, why now? Why is this session happening today or at this time or by us, frankly? And what we know, and you all have shown us an interest in, that year-end planning is obviously a very strategic time to start thinking about these goals, your charitable planning, your philanthropic goals, as well as your tax planning goals. So the timing seems perfect. I also want to thank very much Lorenzo and Nick for doing such an incredible job bringing us from that very high level. I'm glad you presented that part of the program so I can get to the part that really is the doing good in the community, which we love, and that is part of our role. So as a reminder, JCF's role, in addition to handling your donor advised funds and organizational funds, is that we provide expert guidance to help all of you navigate your options with confidence, whatever those options look like. We've worked with thousands of donors and have granted over $2 billion, that's billion with a B, into the community locally here, nationally, and in Israel. And whether you're giving individually or as a family or across the generations, our customized bespoke concierge level of services, we absolutely are sure will meet your needs. So if we haven't achieved any of those things yet for any of you, or you'd like to learn more about it, please make sure we are in touch. And we believe that this planning concept is all about the design. So you work with your financial planner, with your estate planning attorney, with your tax advisors, all the advisors you have in your toolbox. We're one of those advisors in your toolbox. We want to be your philanthropic advisor to help you do the work you can do by benefiting your personal financial circumstances and, of course, doing amazing work into the community. And as you see, we want to make sure we maximize impact, we minimize taxes, and in so doing, we can strengthen community. Now, you've already heard about some of these tax strategies that you can use, and we know, as Ollie said at the very beginning, we are not the tax advisors, and we don't want to give you specific rules that you should take and use. We do want to make sure you reach out to your advisors, but we know, and a quick summary to bring that very high-level conversation down to the sort of level that we might be working at, we know that the biggest sort of trendy piece right now, the biggest opportunity is that you can contribute now in these bunching ways, collect your thoughts of what I might want to give out for charity over the next several years, bundle those contributions together in one contribution into a donor advised fund at this time, receive an immediate tax deduction, and then recommend those grants over any time in the future. There's no minimum, there's no longevity. You can reach out and touch base with us at any point to send that money out. And of course, we have lots of tools for you to do that. That's called bunching. When I'm bunching the amount of money I'm putting into a donor advised fund at this time, and I give away my charitable contributions, I grant them out. That's called granting. We grant them out at a time that's suitable to the donor. We also know that because of what Nick was speaking about regarding the status of the market, is that many people find that the best way for them to contribute into a donor advised fund is to use appreciated securities, appreciated assets, appreciated stock, because the market has done so wonderfully well in certainly the past year and even beyond, that this is your opportunity to contribute the stock, contribute the securities to Jewish Community Foundation for the benefit of your individual donor advised fund. You receive a tax receipt for the full market value of that day, but you avoid any capital gains consequence. So you bought something for $1, it's now worth $10, your cost base is $1, but the amount in your donor advised fund is $10. So a very advantageous way to contribute into the fund and get the maximum tax benefit by doing so. And do speak to us as well because we can help you with those, but we also work very closely with your advisors. The other thing that we want to make sure we consider at this time, because it's, as I said before, why year end, why now? For those of you who are over 70 and a half, we have an opportunity to give directly money from your IRA. Your retirement account is your incredible opportunity to use some of the elements that are provided, some of the laws the IRS have provided to support charity and reduce taxable income. So the first thing is when you're 70 and a half, you may give up to $108,000 a year per person from that IRA directly to a charity without having to count that as general income. But it must go directly to a charity. It's not eligible to a donor-advised fund. We have some other creative ways for you to do endowments and other things, but we offer you the idea to use your IRA as an opportunity to support the organizations of your choosing at this time if you're already 70 and a half. Because when you come to 73 years old, you're going to be required to take an annual distribution. That's called a required minimum distribution. And that is going to come to you as general income, which has to be identified on your adds to your AGI. You can mitigate some of that general income tax consequence by, again, using some of those resources, giving them out directly to charities, and get a qualified charitable distribution. That's the QCD that I show you here. So again, talk to us, talk to your advisor, let us help you figure out the best methodology for your support of charities at this time. And then, because the IRA is so advantageous to use for charity, we in our legacy department here as well will work with the donors, work with individuals to help them use that IRA as part of their long-term strategic planning for after their lifetimes. It's not a particularly advantageous asset to land up giving to heirs, not spouses, but your heirs, children, grandchildren, other people, because it will be taxable by them as general income as well. So these are little tricks that we can use to help you get through that. So please consider that as well. So remind the ways that we can help you here at the foundation. First of all, we think of ourselves as a one-stop shop, right? You can come here for your giving for today, your giving for the future, your giving with your family, your multi-generational conversations. How can we help you be creative with the way that you support one or other organization? Do you need more research about a particular topic or cause or area? We have a whole department of folks who are looking forward to the opportunity to help you design something specifically for you. This guidance will lend itself also to the place where we will research areas of interest or organizations of interest. We will do the due diligence. We'll take you on site visits, and we'll make sure that you are very comfortable with the organizations you choose to support, or just endorse the ones that you already know and love and support in the community. The fact that we've put out, facilitated over $2 billion of grants, 80% of which stays here in San Diego, is really a demonstration of the generosity of our donors who've allowed us to participate in that plan. So thank you for doing that with us. We also consider ourselves real experts. We're experts in lots of different things. I personally am not an expert like Lorenzo and Nick, but I do recognize that myself and our team are highly engaged with what's going on locally, nationally, and in Israel. And in particular, if you have an interest in what's going on in Israel, we have, due to our new integration with our Impact Cube colleagues, we have lots of really good expertise in that space. So we've always had it, but now it's really been amplified. And of course, we coordinate very closely with your advisors. We often get calls from advisors who ask us to work with their clients. You don't have to have a donor advised fund with us at this time. If you just want to connect and have a conversation, we welcome that opportunity as well. So let's think about that as a collaborative effort to build your end of year plans together. So at this point, I think you should consider when you receive these slides after the session, Ollie will show it out to everybody. I'd like you to keep this as your sort of to-do list for the end of the year. The first thing is think about what is the best asset for you to give now? Is it cash? Is it stock? Do you have to consider, would you like to consider real estate or business interests or cryptocurrency? We are equipped here at the foundation to work with you on all elements of complex assets, and we have a whole team of folks who can help you through those considerations, along with your advisors, of course. Think about donor advised funds. Now, you might have one for yourself, and that's great and terrific, but you might think about it this time of year to include a child or make it a gift at the time of the holidays. We have a starting balance of $1,800 to establish a donor advised fund, so we think it's very achievable. It's got a low barrier of entry, and would love to engage your family members and help you have those strategic conversations as a family to get engaged in the philanthropic process. Because the best way to get everybody on board is to actually do the work, right? And give out the grants when you can. Would love you to talk to your advisors about your QCD options, your qualified charitable distributions and IRA strategies at this time. And of course, work with them and us to create your long-term plan. If there's something that we can help you to involve your family, if you need to have some sort of facilitation, we work very closely with many families, both those who just want to work rather lightly with their family or those that have private family foundations and have a very deep interest in some long-term grant and other consulting support. So please let us help you and let us help you use the knowledge we have in the philanthropic space combined with the knowledge your advisors have to create a really sustainable plan for your long-term giving. That's going to help us all create an environment where we can grow philanthropy in our region, which at the end of the day is our mission to help philanthropists grow, to create meaningful and impactful philanthropy, and to make sure that your dollars are well distributed into the community. So I'll pause there and take questions, Ollie, if you have any, or perhaps the attendees have some questions at this time.
Yeah, we got one question in the chat, which was, and maybe Lorenzo, you'll take a crack at answering this more publicly as well, because I know you put something in the chat to the person who asked it. The question was, when designating charitable organizations as beneficiaries of retirement funds, is it advisable to separate the IRAs into those going to the heirs and those going to the 501c3 organizations? Does that make it easier for the IRA trustee? And maybe you could just layer into that again why IRAs are such a good vehicle for charitable giving.
Yeah, so like Charlene mentioned, IRAs are pre-tax accounts, meaning that money inside of those accounts has not been taxed, but they will be taxed upon withdrawal, whether the owner of the IRA takes that draw as a requirement of distribution or to satisfy living expenses or a trip, it will pass through the tax gate. Post-mortem, heirs or people who receive that account or inherit that account will also have to pay the tax bill on that account. If you designate a charity as the beneficiary of that IRA, charities don't pay income tax, so they can get that money in a much more tax efficient way. So if you had a Roth IRA and a pre-tax traditional IRA, and you made your son or your daughter the beneficiary 50-50 with a charity and 50-50 of the other one with charity, it would be much more efficient to give all the Roth IRA to the people and give all the traditional IRA to the charity that you want to support. From a tax point of view, they'll get the same amount of money pre-tax, but after tax, the heir will get much more bang for their buck. In our experience, we've never opened a separate IRA to segregate the funds that will go to charity. With pre-tax or with any retirement accounts, it's really easy to send money wherever it needs to go once people pass away or after people pass away. So I don't think there's a lot of benefit to opening a duplicate account just to hold the charity funds. Yeah, I don't think the logistics would improve that much.
And thank you. And Charlene, can you just talk really quickly about, I mean, I know you're going to say some stuff anyway, but also about why sometimes estate and trust planners and the people planning your charitable or planning your legacy don't even think as much about IRAs as they could or should.
Yeah, thank you for that. And thanks, Lorenzo, for explaining. I agree. We have not had any concern about using or splitting IRA beneficiaries between people and charitable organizations, and in particular, the Jewish Community Foundation, which leads me to Ollie's part B of the question, because we have the mechanism, we are advised by the IRA custodian post-mortem when this occurs, and Eli Landau, our CFO, has been through this many times, and there is paperwork that we do that allows us within a certain period of time to bifurcate the distribution. So the portion that comes to us, which is the charitable portion, there's paperwork that we do that's part of the inherited IRA situation. It's no problem at all. It's just paperwork. We're very familiar with it. But to Ollie's point, this is very important. I didn't get into a whole legacy conversation, but it's critical. An IRA as Lorenzo said, which is pre-tax dollars, sits outside of your trust. It's not listed in your trust. It has its own beneficiary paperwork. It's a taxable event when the money is taken out or at least inherited, and therefore it's different to a trust. And so, what many of our advisors prefer, and frankly, our donors prefer too, is rather than trying to list every organization's percentage of receiving that amount from an IRA after lifetime, I'm talking about here, or even listing names in a trust, what you can do is simply have a beneficiary sentence, which we provide, that says we leave these assets X percentage to the Jewish Community Foundation to be distributed according to the most recent signed legacy instructions on file. And then we create a specific set of documents that demonstrate and document your intentions. So I want X to go, this percentage to go to that place. I want a percentage to go to this place. And we create your whole charitable estate plan using one beneficiary language, which really uncomplicates the whole situation for your charitable, for your estate trustee to have to distribute those assets. And you can do the beneficiary paperwork for the IRA for free, directly online with a beneficiary form that doesn't require attorneys or other expenses. And we can even help you to navigate that and show you how to do it, even though we don't do it on your behalf. And all the conversations that we offer to do for you, those legacy plan instruction conversations, are complimentary, confidential, and we do it in consultation with your advisors. So thanks, Ollie, for queuing that up. It's a wonderful opportunity for future charitable planning. Do talk to us.
Great. There was a question in the chat about TSPs, which I had to look up because I didn't know what that was. It was about thrift saving plans, but that one got answered in the chat as well. I think that's a pretty specific question, but thanks for answering that, Lorenzo, in the chat. Um, uh, Different topic, different question for Nick. There's been you touched on the concentration in the S&P. You touched on sort of the sort of are we in the sort of dot-com kind of era bubble? I was wondering if you could talk a little bit more generally about bubbles because one of the things I was just looking at my podcast feed, and literally like three of the first podcasts that came off my podcast feed is this the end of the everything bubble? Ride the bubble or seek safety? And then even the Daily from the New York Times, is there an AI bubble and what if it pops? So if everyone already knows that we're in a bubble, are we really in a bubble? And is it going to pop or when will it pop? Discuss.
Yeah, if a tree falls in the woods, I know I think I listen to a lot of the same ones, Ollie. So I know I always say like I've always just different schools of thought. I subscribe. You don't know when you're in a bubble until after it pops, and that's usually what it was. I think back often to there's a quote at the beginning of the movie The Big Short by Mark Twain. Do you see that? It's not what you don't know that gets you; it's what you know to be true but ain't. That's usually the case. And so what I would say that I wouldn't, the reason I kind of discounted bubble talk is because for bubbles, it needs to be artificial. You think about people with no income having six houses that are all fully mortgaged. You think about the tech bubble where then valuations were 50 times price to earnings ratios, and these companies had negative earnings. Pets.com is always the example, or flat out fraud situations and an Enron WorldCom situation. Those are things if we knew at the time, people wouldn't be throwing their life savings into these things. But what's different today is that these companies are making money. Now, there's a lot of discussions you can have around, well, yeah, a lot of them are giving money to each other because they're all, you talk about ChatGPT and OpenAI buying NVIDIA chips and Google and all this stuff. But at the end of the day, these companies are making money and they are using not debt, but free cash flow on their balance sheets to then put in a massive amount of capital expenditures, which helps the entire economy. I talked about tariffs being a 0.5% GDP drag. Well, the 200 billion that these hyperscalers have invested in CapEx has added 1% to GDP this year. So they're putting cash back in. They're starting to borrow a little bit, very little, but that's why we saw a little bit of a pullback over the last week. But at the end of the day, they're using cash to invest in the economy. That doesn't feel very bubblish. And on top of that, I talk about price earnings ratio, gets a little wonky, but the average is about 23 for an IT firm. They're at about 29, a little overvalued, but a 10 to 15% market pullback, which is very normal, puts us right in line. It's not Here's 23 is the average. They're at 50, 60, 70. So that's why I kind of discount the bubble talk. Again, I'm not, I can't tell the future. Who knows there could be all sorts of other things going on, but that stuff to me makes it feel a little bit different than this traditional bubble situation. So that's why we're not as concerned.
Great answer. Um, and
Oh,
then
sorry, excuse
go
me
ahead.
interrupting you. I just want to go back to one thing I just thought of because that's what happens, right? We think of things after we hang up. When I was mentioning about the beneficiaries listed as JCF and then using a legacy set of instructions, I just want to also add one of the reasons that's so beneficial is that should you change your mind anytime during your lifetime, you can simply go back to JCF and say, well, I want to give to more to this place, or I want to give less to that place, I want to add a different organization without having to return back to your trust or attorney to make those adjustments. So that flexibility that I spoke about in my very first slide, that JCF wants to do something custom just for you, goes from what I call today, giving for today, tomorrow, the future. That flexibility goes all the way through from what you want to do now to how we can support you and honor your lifetime of giving after your death. So just that flexibility piece, I want to make sure we include.
That's great. Thank you. Um, So I think to wrap up, I mean, I think that there's been some fantastic sort of detailed information about where we are with markets generally, some of the changes this year. I mean, I think most of the people on this call are probably itemizers rather than people taking the standard deductions. So there are some fairly substantial sort of tweaks, particularly if you're in the 37% tax bracket. I think Lorenzo's example would mean, you would get $6,000 less of a deduction in 2026 than in 2025. So that's why bunching might be a great technique for 2025. Um, and really, I think that we're in an interesting place economically. We're in an interesting place in markets. But we are here for you. So we put our information in the chat for how you can reach out to us. We will send out a recording of this after the session. We'll also provide contact information for the speakers. Um, and we have another question. Um, no, someone put up their hand, but then put it back
Well,
down.
yeah, if you just document your question in the Q&A, then Ollie will ask the question for you.
Oh, maybe it was a mistake. Um, so um, And so we will send out a recording afterwards with all the information. I'm also putting in the chat again our link to our end of year giving guide. But really, thank you guys so much for your time. Wishing you happy Thanksgiving, happy Hanukkah to those who celebrate. And we're here for you for whatever you need in the future. Thank you, Nick. Thank you, Lorenzo. Thank you, Charlene. And we'll talk soon.
Thank you.